Welcome to the Broken Pie Chart Podcast, episode 370. I'm your host, Derek Moore. Once again, I'm here with Mike Snyder and Shane Skinner. All right. I thought we'd bring on a special guest, Peter Lynch, Peter's not with us here today, but I wanted to play something real quick. And I think it's kind of apropos we play this.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. It's good when
All right. So that's Peter Lynch, 1994. That was a C-SPAN clip. I'll put it into the show notes. But yeah, I mean, we're basically, I guess we're in a correction now. Are we 10% off the highs? Mike, is that where we are?
I think not quite, but close. And yeah, I think you've said it before, and I kind of like the way you put it. Like, if you take away the headlines and you just look at the chart, you would just think, we've been due for something like this.
We have. I mean, let's look at year to date. So the S&P 500 year to date, if I just go from December 31st to the close today, it's down 5.12%. Now, I think that's not the high. Shane, when was the day of the all-time high? Because I can actually do the official math from there. Is that February?
Yeah. If you're looking at all-time high on the S&P 500, it came on technically January. If you're looking at SPX, January 28th.
Okay, so January 28th. And then I think intraday, we actually had... Intraday went over, 7,002. So maybe I'm thinking off 7,002 to the lows today. But from the high, total return minus 6.97%. But Mike, getting back to your point, and thank you for sharing that I said something good. Yeah, like cover up the headlines. The headline, I think the headlines are worse than the markets. And if you said coming into the year, you were down a little over 5%, you would say, okay, well, midterm years tend to be sideways to a little bit down. But I think that's your point, Mike, right?
Yeah, exactly. I mean, more often than not, markets go down, have a drawdown of 10% in a given year and still end up positive for the year. So, right now this is really just a blip, I think, in a longer term bull run that we've been in. How long we stay down here and how much lower we have to go, we'll see. But at this point, this is, everything could be the same as it was 6 months ago, and this could happen. And you could just say, this is a normal correction that happens in equities.
Shane, I'm going to give you a quiz. And 1987, I know you were not in the markets in 1987, but 1987, I feel like you already know this. I should bring in somebody on the street but what was the market up or down in 1987? And the crash was in 1987. What was the market up or down that year?
I want to say it was up or down maybe 3%. If not
it's
flat.
According to JP Morgan's Guide to the Markets, up 2%.
Up to? Yep.
Yeah, the low was 34%. And in fact, when you look at most years, intra-year, markets pull back at some point, and often that they want. Now, I'm not saying it's going to happen this year. There are years like 2008 where the markets were down 50%, and then they closed down, without dividends around 38%, with dividends 36.5, 37. So 2022, down 25%. They wind up closing right around 19% down. So just because you go down doesn't mean you always go up. But I mean, 2025, the markets were down, is this right? It was down 19% at one point and closed up 16%. So
Right.
that's right, because it was wasn't that the yen thing? Is that the yen carry trade, Mike? That was. So I guess the point is when Peter Lynch, and that was 1994, and if you don't know who Peter Lynch is, Google him. You can read one of his books. He ran Fidelity Magellan's fund back in, I think it was from the late 70s into the 80s, and he beat the market. And he beat the market, beat the S&P. He was a stock picker. So he's a pretty famous portfolio manager. And what's kind of interesting is at one point, it was kind of at the height of his power almost, for lack of a better term. He kind of walked away. I've seen him on TV recently, and I've seen him be interviewed. He's still interested in the markets. I think he has some affiliation with Fidelity still. Maybe he's an advisor or something. But he basically said, once every 2 years, the market's going to go down 10%. Once every 6 years, you have a 25% decline. That's called a bear market. So I don't know, Mike. So are we going to close up this year? Like, what's your year-end? I'm kidding. What's your year-end prediction?
Yeah, I mean, I think, this shouldn't make you change, your plan, right? Like, I don't think anything has changed in terms of earnings. Analysts have not lowered earnings. So, the market's really, if you believe in those earnings now, and maybe they're going to lower them at some point, the market's getting ahead of this. But if you believe in those earnings, the market really at this point is just cheaper. Of course, there's right now higher input costs with oil going up, and maybe those earnings do get revised lower, but they haven't yet, and so the market's just looking cheaper than it was.
Yeah, Shane, when we look at this, we were at a 23.3 forward PE ratio. Earnings estimates continue to go up. We talked about this in length last week on the podcast. So market is on a forward basis drifting towards 19 times forward earnings. And at the same time, net profit margins for the next 12 months, based upon the analyst estimates, sales per share, earnings per share is about 15%. That's high. So, I mean, Shane, I think if you want to make the bear case, you would say, yes, analyst estimates are good for now, right?
Yeah, absolutely. I think that's sort of like, this is a big game of chicken now. I think it's sort of a wait and see period here. Like, the market, obviously, like we've said, doesn't like uncertainty. And yet at the same time, if you take all the noise away and what's going on, in the world, if you just look at the chart, like we said earlier, it looks like this was more than due at some point. I think the biggest issue here is, like, the market can't decide whether or not this is going to be a long lasting impact. If we're in a market where, say, oil is, somewhere between 70 and 90 pretty consistently for a couple of years, I don't think that's actually the end of the world. I think that we're okay. I think we'll be fine. If this becomes a situation where, like, the supply of oil gets so constrained that we actually have, like, an energy crisis globally, I don't even know if earnings expectations even matter at that point, right? Like, you sort of throw those out the window, and we'll revisit those once we get the more broader issue addressed. And so this is where I think, all eyes are on that, and less about, and that's sort of how the market seems to be behaving too. If energy gets back in line and this gets resolved, I wouldn't think that earnings estimates would be whacked that much. Maybe they come back down a little bit. But, everything right now seems sort of in line, and now it's just a matter of how does the situation play out.
The market right now, it's not sure, is this going to be a long conflict? And
Right.
I don't know if we said this last week, Shane, but I've shared with you guys, my prediction was at some point Trump is just going to come out and say, yeah, we're negotiating with them. We're close to being done. And even if they're not talking to them, he just has to say, and he's going to do the assumptive close. Yep, we're talking. He's going to say we came to some agreement. And it sounds like the Iranians are like, wait a second, we're not actually doing that, but he's just going to do it anyway. I mean, the longer this goes on, and I think to go to the analyst estimates too, like they don't really know what to put into their estimates yet. They don't know. Like the last thing an analyst wants to do is make a snap decision and downgrade the estimates. But Mike, I would tell you that often, and there's this old adage, does price make news or does news make price? And the technician would say price makes news. In other words, if there's news that comes out and the market's unchanged, well, it's not really news. But the market going down, a lot of times analysts follow that. Mike, we saw that in 22 where the markets were going down and they all lowered their year-end forecast. I don't know. I mean, do they start doing that? Do they need to?
I think the market's very divided at this point. Analysts are probably feeling similarly. I think that's why we've seen sort of what we've called, like a controlled sell-off here. There hasn't been a huge down day yet. The VIX has been creeping higher, but I think the market's very divided on, like you said, how long this is going to play out. And I think the analysts are probably feeling the same way, but the market continues to drop. I think the analysts' hands may be forced in saying the market's telling us something here, that these oil prices are going to have a bigger impact on earnings than maybe we're thinking at this point. But like you said, they don't have, it's hard for them to figure out, they have to know how long this is going to go on too, so that, they can adjust their estimates. So yeah, I do think at some point, if the market keeps going lower, that it probably will force their hand.
Do you either of you guys think that maybe too, like, who wants to be the first analyst to try to predict or make the call that this is going to be longer lasting and start lowering targets? And, one, you're at risk of this being wrong if this wraps up over the weekend or the coming weeks and doesn't last nearly as long as some people are fearing. That's not a great look because you're probably going to quickly revise then again. Do you guys think something with that might have something to do with it too?
You get herd mentality. I mean, why is it
Right.
all the analysts cluster around a certain level in the S&P?
Right.
Let's put 10% on the closing price December 31st, and that's my forecast. But somebody's going to do it. Somebody's going to do it. I mean, if this is a way to... And do analyst estimates even matter anymore? They matter because that's how we do our valuations. So I guess it does matter on a forward basis. But I don't know, like Mike, typically markets react before the numbers. And markets start to rally before the numbers get better. Market's kind of forward looking. So to your point, Mike, like the market's telling us something here, right?
I think so. I think the market is warning you that earnings may not be as strong as they're currently estimated.
All right, let's look at it.
Yeah.
Oh, go ahead, Mike.
No. That's all I had.
I want to just talk about interest rates and interest rate forecast right now. So in Bloomberg, I went back and I said on January 2nd, what was the Fed funds futures? What were they pricing in as far as an interest rate cut? And the answer is by the end or by the October 28th meeting, 100% probability there would be two 25% cuts. So 50 basis points. And if you did that, then rates would be at 325. Today, what is today? March 27th as we're recording this. The Fed funds futures, it's a low probability, but by the September meeting, there's an 11.9% probability of an interest rate hike of a quarter. A hike. Like, really? So these move around too, right, Shane?
Didn't I bring this up in the I know I know it wasn't necessarily a perfect linear prediction from my predictions earlier this year, but I think I had this one in there, and I think everybody thought I was a little nuts for it, and I was wrong on why I thought they would hike potentially. But here we are. The market seems to think maybe they will.
Or people are hedging and they're using the Fed funds futures and the Fed, the way you calculate the implied interest rate at a certain month is you look at the price of the future and you do some math and you come up with it. So maybe it's just people are using these to hedge. But I still disagree. And I think, like Shane, we made the point a few weeks ago, you can't have it both ways. You can't tell me that they're going to raise rates while the economy is falling apart. Like, that makes no sense to me, because you better be careful what you wish for. And if people think they're going to raise rates into a bad economy, that's not great.
Well, right, exactly. And I mean, the Fed is in a really troubling position, and a new Fed chair is about to step in here in a few months and tackle one of the nastiest situations the Fed's been in probably since COVID, I would say.
I don't think it's that bad. How is it that bad?
I think that what the issue that they're about to have to be involved in, again, this is if the energy situation continues to to be an issue, right? The Fed is equipped to deal with demand side inflation way better than it is supply side inflation.
Yeah, they can't do it. They can't do anything with supply.
Anything with supply. Exactly. So where I'm sort of concerned, it's not even that it's like the Fed's fault, but it's like, if this energy situation continues to be a problem after enough time, you're going to be in a situation where you might have inflation up a ton, not because of necessarily demand. It's going to be a supply shock, which we talked about, I think, last week, right? We were bringing up shipping containers and the ships crossing the strait, and how it always goes back to tankers and ships and the supply
always
chain.
Goes back to the boats.
Goes back to the boats. They're in a tough situation, because now you're cutting into rising inflation that's not necessarily their fault, but you've also got the unemployment potentially rising as well. I mean, it's a really not great.
You
spot.
get back to when all they have is a hammer, all they see is the nail. And
fair, yeah.
I go back to 21, 22 when they raised rates. And I said back then, I don't think them raising rates did anything to bring down inflation. It was a supply side issue, and it was helicopters flying overhead, dropping money for people to buy goods that needed to be shipped from China on boats that were backed up and not available. Like, it was so clear the fiscal stimulus had to sort of run its course, people had to spend it, get it out of their system, and you had to fix the supply side. They could have not raised rates one bit. Now, the counterpoint to that is housing. And definitely raising rates cooled the housing market and stopped people. A house goes on the market and there's 17 bidders bidding above the price, and no one's ever even been inside. I saw that stuff in Scottsdale. People would put a house up for sale, have an open house on a Friday. The for sale sign is sold on Saturday. So, maybe that needed to temper things. But, Mike, like, if you're telling me that there's going to be, people are trying to say that we're going to have stagflation. Stagflation meaning high inflation, low growth. And really, it's, in my mind, you need to have high unemployment. But this whole concept that the Fed is going to start raising rates, for what? Why would they do that, Mike?
I don't know why they would do that, but then there's this side of, will they do that? Like, I don't think that they need to do that, but will they do that?
The new Fed chair is going to come in and I just told Trump I'm going to lower rates.
I don't think that they're going to. In fact, I would say, and this is not what the futures are obviously saying, but I would say it's still more likely that there's one cut than one raise for sure. But yeah, I think the Fed came into this year thinking, okay, inflation's something we're not going to worry about as much. We're going to focus more on the economy and jobs, and this is going to give us an opportunity to cut rates. and now inflation for reasons that may not, that they really can't control. Like we said, this is a supply side issue, but the inflation number is there, and I think they're going to have a hard time in the near future lowering rates into these numbers.
Well, it might be, would be really funny at Powell's last meeting. He said, no, we didn't raise rates this time. We're watching it. We think it's transitory, though. That's what I want. I want him to use the transitory word again. That would be pretty funny. All right, let's talk about equities a little bit. The Mag 7, and I look at MAGS as an ETF that holds the Mag 7. Their all-time high was October 29th. And it didn't quite close there, but they're down just about 20%. And so in theory, what is it? Over 20% is the bear market. You need to close on that. So they're just inside of a bear market. So I bring this up, and I think it was JC Peretz. I saw somebody passed it to me on Twitter. He showed a chart of the Mag 7, and he made the point, like, for any material recovery in the markets, these stocks probably have to start doing something. Like they're too big not to do something, I believe was his thesis. And I think he's right. I think you need to see these stocks at least stop going down. But I don't know. I mean, there's also dispersion in these too. So if I should have done this ahead of time, but I'll do it now. And what do we say? October 29th was the all-time high. Did I say that, Shane? Is that what I said?
October 29th. I think that was NASDAQ. Yep. For tech.
Okay. I'm thinking about the Mag 7 though.
Yeah.
So Mag 7, it was the same one. Yep.
Well, yeah, of course, right? Those kind of line up, right?
Correlation, Yeah.
Yeah. So, I mean, that ETF is down, the price change is down just under 20%. But if I just look at the individual companies, so of the 7, which one do you think is the best?
Apple.
I know the answer is Apple, right? It's got to be.
Well, let me see. Apple is down a total return minus 7.57. Microsoft is down 33.84%. 33, almost 34%.
We're below our 200-week moving average on Microsoft. That's not something that happens very often. For those of you that don't know technicals all that well, like to be that below the 200-week moving average, this is pretty considerable down move in Microsoft.
Tesla down 21.6. Meta down 29.94. I'm just doing a comparison here. AVGO, right? Is AVGO Broadcom in the Mag 7?
They are, I think are they the 8th? Are they like right outside it? Or are they in?
Oh, NVIDIA. Why couldn't I remember?
Tesla and
NVIDIA. And Google, yeah. So
yeah,
NVIDIA's down 19.08. And then if I go to Google, GOGL or GOG, take your pick there. Oh, you're wrong, Shane. Google is up 0.5%. Is that right? Since
I believe it.
October 29th. Yeah, so it's better than Apple. So the reason why I bring that up is you have this sort of dispersion. Google L is up slightly. Google without the L is down 0.38%. Anyway, so there's your answer. There's the best one. Microsoft is the worst. Google's the best. And so, like, what needs to change in the big companies for some of these to start to work again?
Well,
and
I mean, Derek, do you think that it's got to do with the fact that if you were to just have to blindly guess who's probably winning AI right now more than anybody, I would probably put my money on Google. And then I would say who is maybe in a place to benefit from AI significantly that hasn't dropped a ton of cash on it. You would probably say Apple, right? So is this just sort of us getting a look at who the market for now thinks is really winning with this stuff, who's been smart to sit to the side, and it's punishing the names in this index here that have just overbought and overinvested into it?
I mean, my working theory is that Microsoft is a proxy for OpenAI because they've got the investment there. But here's the other thing, like you look at these companies and when everything was going up, there was not this much dispersion. So let's think about it this way. If I reverse engineer it and I say, okay, instead of my start date April or October 29th, I'll make my end date October 29th. And then I'll say, what did they do up to October 29th from, the end of 2024? So what was their year to date 2025 through the all-time high? And you start to look at these, then it's Google up almost 45. It's NVIDIA almost 54. Microsoft almost 30. The Mag 7 as a whole up 27. So maybe there was more dispersion than I thought. Tesla up 14 and a quarter, Meta up 28. Apple was kind of the one, probably the worst performing. Yeah, up 8%. So I guess I'm wrong. I'll take that back. There was dispersion on the way up as well. So I don't know. I mean, I think it's going to come down to earnings, Mike. And as these companies report earnings, we're going to see, to your point, can they deliver the earnings? What do they say about the forward earnings? The dollars come down a little bit, which I think could help. But actually, let's see what that is right now. The spot dollar index, it's hanging around 100. So it actually hasn't really come down. It's just been kind of hanging around there, but it hasn't gone up more. So yeah, Mike, I think your point's well taken that earnings, like we're going to learn a lot when earnings season starts in April.
Yeah, I think that's how we get these companies to move back up. We need to hear them talk again and be reminded of what they're doing, and build some momentum again and hear that their earnings are solid in spite of everything that's going on. We saw them really trading sideways to lower for a while prior to the war in Iran, and energy and other lagging companies really moving higher, and the market overall did nothing. And that to me is another sign that for the market to recover from here, you really need the big names to lead it.
Yeah, well, value's finally getting their day, Shane. Like value investors have been like, one day it will happen. I swear.
Gold bugs, silver bugs, right? But it's, you mentioned bonds moving up earlier. Was that today or yesterday? I think. And I think what would we say? Good, right? You said the correlation of everything moving in the same direction all at once across asset classes, at least temporarily, has looked to maybe it's subsiding. And I'm a believer that if you want healthy markets, that's what you want to see, right? You want to see flight to quality actually playing out as you would expect in a situation where you would think people would be moving the flight to quality, right? Stocks to bonds, bonds to gold, or other commodities. So,
well, to your point on gold, we basically bounced off intraday the 1231 close. So, 396, but round up to 400. 400 at least currently, it seems like that's the bounce level. I don't know if we'll see what happens. But I feel like, Shane, like the tourist might be out of gold, just looking at the flows out of the ETF.
Well, absolutely. And I think that if you're somebody who is new to this or recent to this trade, you've been hearing this entire time that gold is this hedge against, inflation or geopolitical risk or, uncertainty and all this. When no one knows what else to do, you go into gold, right? And, if you got gold a month ago, I hope you're not crying right now, but like you might be. It's taken a really big hit relative to the high, right? So, if you've been in this steady in the long run, you probably haven't thought much of it. But yeah, the excitement around the gold trade might have died down a little bit. So, we'll see.
I'm looking at copper right now, Mike. I know you're a big fan of copper, and you follow that. You trade that intraday 1,000 times. No, I'm kidding. I mean, look, copper's come down too, but copper is still, it's holding a little better than gold. And it's not that much interest. People aren't like buying copper, putting it in their portfolio. Let me put a 10% sleeve in copper. And in the old days, they said, Dr. Copper, and it was good proxy on China because you need copper. Now, I believe copper is needed in the data centers. I've seen that maybe there's some shortages there. But at one point, it was like, I mean, I'm older than both of you, but it reminded me of the 90s when everyone was buying Telefonos to Chile, Telefonos to Mexico. Any of the Telefonos companies, like people just started looking for the new country to Telefonos to whatever. And, we saw things like, what was it, palladium?
Yep.
We saw that was, that sort of ran. And if I look at palladium prices today, palladium is very off its all-time highs. In fact, I know you guys can't see this, but I'll just tell you I'm looking at the futures contract for palladium. I mean, it pulled back almost 40% from its high. So that trade of buy any metal seems to have subsided, and people will move on to something else.
Kind of a widowmaker's run there, and metals in general. You talk about the widowmaker trade being nat gas. And for those who don't know, nat gas futures and options on them, if you're on the wrong side of a really big move in nat gas, it can be very ugly. But again, Derek, you imagine thinking now's a good time to get into these metals as they're trading near those highs? And then,
well, I mean, I still think gold has a place in the portfolio. We run some strategies with gold in it. The idea that gold was going to go up, I was going to say 50% a year for a couple of years. I think it just did that. But, the idea that, it's going to go up another 100% or another, I don't know. I will tell you too, and I don't want to spend too much time on this because I want to move to our recommendations. But I mean, Bitcoin once again hasn't been a hedge against anything. It's a risk-on trade. Have you seen Bitcoin's price?
Yeah.
Yeah. No, I mean, that was one thing that even concerned me when it was going up. The market was very strong, and Bitcoin just traded with it. It didn't seem like any sort of hedge. And if it is what it is, it shouldn't just be moving with equities.
I'm looking here. Let me see if Saylor has bought any. I didn't prep this, so let me just see the purchases. Okay, so their last purchase was, their average cost for Bitcoin is $75,694 now. And if I look, how much Bitcoin do they have? Oh, it's 66,007. So what did I say they bought it at? 74,000 and change? Their average purchase?
Yep.
Okay, so Bitcoin is 66,000. So the Bitcoin people don't like when I bring this up, but I'm going to do it anyway. So 75,694 divided by 66,000. Okay, so their average cost is 75,694. So they're up 14.7, and they have their purchases listed back to, let's see, listed back to 8/10 of 2020. Okay, so 8/10 of 2020 is the last thing I'll do, and then I'll be done with this because we got to move on. What did I say? 8/10 2020. I'm going to see what 8/10 of 2020. Okay, go there. All right. Now, all right. Now it's not fair because he's dollar cost averaging into it, but the S&P's up 39.79% since then. That's not fair the way I did that, and I'll admit that because
Yeah, but you got to also give it. Let's be so for real. I mean, prior to
Bitcoin's still up more than that, but it's
but prior to becoming an ETF that you could trade on most brokerages or exchanges, or crypto becoming made available widely on most well-respected, reputable, and long-standing brokerages, and or places where you can do these types of transactions with these assets. Like, that it wasn't until mid 2020s here that, or early 2020s, that you were able to really get access to this on the secondary market. Prior to that, this is something that I think the first big financial instrument were notes or trusts and futures around it before, right? So I guess what I'm getting at is, like, prior to Bitcoin becoming almost like modernized and available on the secondary market pretty consistently and widely available, this was something that was in its own ecosystem with its own people using it and operating within it.
They weren't quick to sell, and that's the thing with ETFs now.
Right.
People are selling, and I don't think anybody's rushing in to buy Bitcoin.
No,
and I got to move.
Yeah, go ahead.
I got to move on from this because we want to get to recommendations. But I will just say I find it interesting that they took off the Bitcoin yield and some of the other metrics off their site. I wonder if they were negative and they didn't want to show them anymore. I don't know. Somebody else can tell me that. Shane, what about recommendations this week?
I'm going to give a pre-recommendation.
Oh, pre-recommendation.
I got to give a pre-recommendation simply because I know it's going to be good. All right. So it's A24 House doing Born to Bowl on HBO Max. And it is a documentary on bowling. It follows 5 famous professional bowlers. A couple of them you may know from whatever.
I don't know any bowlers. No, I don't.
You at least, you got to know, who do you think you are? I am, right? Everybody knows that one.
I don't.
No? All right. Well, I'll send
Pete
you that.
Weber, I got you.
Pete Weber, thank you. All right.
Okay.
All right. Mike down.
I know nothing about this. No.
Yeah, I look forward to it. It should be interesting.
Mike, what about you?
Jury Duty is the show. It's on Amazon Prime.
Oh, I've seen this.
Did you see the first season?
Yeah. Is it out again?
There's a new season out.
Oh.
It's similar concept, but this time it's a company retreat, and the one person who's not an actor is hired as an intern to go on this retreat. So I think there's maybe 4 episodes out so far. Very funny, the situations that he's put in.
Who's the famous person in it? Because last time it was who was the guy?
James Marsden. There is no famous person in it this time.
Oh, they should have done it. Maybe people think now that that's been out, they would catch on. Like, this isn't real.
Maybe, yeah.
I thought the first year was pretty funny, and I thought James Marsden was hilarious in it. Yeah, like, it wasn't the best show, but it was good. It was entertaining.
Yeah, exactly. This season is similar.
All right. I watched 3rd episode of Rooster on HBO Max. Yeah, I think I'm going to stick with my buy recommendation. Could be a strong buy. But other than that, we're getting to the last, I guess it's the 10, 12 games in the NHL season. And if you're a hockey fan, there's a lot of teams clustered right where they could make the playoffs, they couldn't. So it's almost like the playoffs before the playoffs. And there's nothing like hockey playoffs. So the 2 Chicago guys on here, excluding me, I don't think your Blackhawks are making it this year.
No, but some promising young guys coming up on the team. So they are still fun to watch.
Bedard's pretty good. You might be onto something there with him.
Yeah, I know. I'm really going out on a limb there.
I feel bad for the Toronto Maple Leafs fans who, if anybody doesn't realize, they're kind of like the New York Yankees of the NHL. Famous franchise, but they haven't won in a while. And they're kind of snake bitten with some injuries. Last couple of years, like, they just haven't got down to the playoffs. I think they finally got to the second round. Tough. I don't know what they do there, but maybe they go get McDavid. That's another podcast to listen to, though. All right, guys, I think we did it. I think we got through it. For everyone else, we'll be back next week. We'll see if the market holds at right around 10% down, or I want to see what the analysts are going to do, and then earnings. So good stuff coming up. Thanks, everyone. We'll talk to you soon.